please. So on 12th, sale occurred because you received cash from customer, contract is done. So entry would be cash to sales, right? But when you deliver it, you deliver it. But if she said, okay, have this advance, I will have this 30 yuan advance, I will be drinking this coffee tomorrow. Sale occur today? Answer is yes. And how you record it? Because that is unearned revenue. Revenue occurred? Not yet. This is unearned revenue. That is liability. But you receive cash, you record the cash right now. Cash record, cash increase, debit. And did you make the sale? No. We call this unearned revenue or sales. For example, 30 yuan, 30 yuan. So this is liability. Don't go to the name. This is liability. And tomorrow when she comes and say, okay, give me my coffee, I paid you yesterday. So when you deliver the product, so deliver the product, then sale occurs. So you decrease the liability decrease, debit. Unearned revenue to revenue. So you will record cash yesterday, this accounting, and today you will record this unearned revenue to revenue. Revenue increase, credit, liability decrease, debit. And entry would be unearned revenue to revenue. So we will talk about these entries a couple of more times in our coming slides. Just going to give you a little taste right now that sale occurred when possession is transferred. Until then, if you receive cash in advance, that is your unearned sale. You are not entitled to record it as a sale because sale didn't happen yet. Sale happened on the same day, on the same date you record it, whether cash is received or not. Cash is irrelevant with the sales, right? If you receive cash in advance, then you record it in advance, unearned revenue. If you receive later, then you record it as customer account receivable. But sale occurred, you record on the day when it is occurred or at that time when it is occurred. Everyone is clear?
Yes.
Oliver?
Yep.
Good. Sufyan, Miria, Joe Paulo, 10, Mirko, Pavarun, Nana.
Yes, sir.
Good.
Yes. Sir.
Now, same with the expense recognition principle. So, expense must be recorded when it is incurred. So, whether you pay for expense or pay later or already paid in advance, that is irrelevant. So, when it is, it is occurred or incurred, you record it right now. That's it. So, identify all expenses incurred during the accounting period, measure the expenses, and recognize. Recognize means record them in the same period in which any related revenues are earned or not. So that's here. For example, the same. For example, here, your employee worked for you for 30 days and you pay salary or their wages on 1st or on 10th of next month, 10th of November. So they work from 1st October to 30th October, but you pay them 10th of November. So how you are going to recognize the expense? Expense are recognized on October. Salary payable, because salary is not paid yet. So salary expense created, yes. But did you pay? No, you create liability. Salary payable. Salary expense occurred, you record it on 30th of October. Do you pay? You will pay after 10 days. So you create liability. You will pay later, you create liability. Salary payable. Salary expense, increase debit. Salary payable, increase credit. So when you pay salary, you decrease the liability and increase the you decrease the liability and decrease the cash. So when you pay the cash, cash is decreased, cash is asset, asset decrease credit, and liability decrease debit. So salary payable. You don't see here, only see the cash expense one time here when it is occurred. Right, guys? Are we clear? So the expense and revenue recognition principle is that you must record revenue and expense when it is occurred, irrelevant when cash is paid or received later or in advance. That is irrelevant. You must record the expense and revenue when it is occurred. That's it. So this principle, why it is so much important? Because this helps us for any, you can say, and basically this is a preliminary, a caution against fraud or something, and also it is helpful to measure proper, record or proper business evaluation performance as well. How much you sell during the month or during the year, irrespective of how much you receive actual cash. So that's why profit is not equal to cash. You sold, you less the cost, you have a profit. But do you have actual cash? No, maybe cash will come later. All right, so that's why now you have learned this concept. So don't believe the accounting statements that okay, if the company earned 100 billion or 100 million profit, so don't believe that there is actually they have this much money in the bank account. No, because customers will pay them later, plus they will pay the salaries and all the stuff later as well. So that is something else. So that's why this accrual accounting is so much important. So illustrate the expense recognition here. So remember, it is the same. So for recognize the expense of a period against the revenue earned during the period. So we have A, net income, revenue minus expense is equal to 200. So revenue minus expense, we have a loss here. So that's why we have revenue minus expense. We don't have cash minus all expense, cash inflow minus cash outflow, right? Guys, you understand? In cash accounting, how we find out the profit? Cash receipts minus cash payment. Answer is net income or loss. So if that is 100, it means 100 is in your bank account in cash basis accounting. But here, that doesn't mean that, okay, this was occurred, loss, yes, occurred. But that means that your bank balance is now decreased by $100. That not necessarily mean. Maybe later it will be decreased by 100. Maybe later it will be increased by $200 profit because customer will pay us later, or interest income is coming a little bit later, right? Are we clear? Let me ask one by one because this is very important and all our future discussion depends on these two principles. Mirko, understand? Oliver, Venetia,
Yes.
Tara, Mina,
Yes.
Paulo, Nana, Ten, Pavarun, Miria.
Yes, sir.
Yes, sir. Understood.
Yes, sir.
Yeah, understood, sir.
Marco and Subhan.
Yes, sir.
Good.
Yes, sir.
Good. Let's move further. Now adjust the accounts. So adjusting entries. So in addition to all other, entries that we discussed, okay, we started the business, we pay rent, pay all the stuff. We must adjust the entries before closing the account. So what is the closing the account? This is the account when you are balancing. Recall our previous discussion. How we make the balance, whichever side is greater, the balance would be there, right? So before this closing the account, we adjust some of the accounts, not all accounts, some of the accounts are going to be adjusted. So journal entries made to ensure that revenue and expenses are recognized in the proper accounting period. So it is generally made at the end of accounting period. It includes at least one income statement account and one balance sheet account. So this is a mixed entry of, it means one item belongs to income statement item or income statement account, on one belong to balance sheet account, right? So one account belongs to income statement and one belongs to balance sheet account. So what are the income statement account? Revenue, expense, dividend, right? What are the balance sheet accounts? We have asset account, liability account, owner's equity account, right? Like, so, furniture, land, building, cash, accounts payable, loan, debt payable, bonds payable, notes payable, retained earning, common stock, right? These are balance sheet accounts. Now question occurred, which accounts need to be adjusted? So this is unadjusted trial balance. You see here, unadjusted trial balance. So this is trial balance, which show the balance of each T account. Cash T account balance is debit, 36,800, account receivable, prepaid rent, right? So prepaid rent, remember that one. You paid in advance, and now you are making balance sheet for 30th June. So from this 3,000, how much rent you have consumed? Maybe this is for 5 or 6 months, $500 a month. For example, you are making this after 4 months. So 4 months rent is 2,000. So it means this balance is not correct balance. We need to adjust this. So one item belongs to balance sheet. So prepaid rent is balance sheet, and rent expense which belongs to income statement. So we need to reduce that. From this 3,000, 2,000 becomes our expense. We consume that, right? So let's just talk about which accounts need to be adjusted. So there are 3 types of accounts that need to be adjusted. Number 1, deferrals, delayed payments, right? You delay the payments. For example, tax. Every time you sell, you collect some as a sales tax, but you deposit at the end of 4 months, 3 months, or whatever the time period, right? So you need to deposit to the government account. Same salaries tax, sales tax, income tax, and all the stuff. Depreciation, the consumption of assets, wear and tear of assets. I use this laptop and now value decreases at least 1,000 yuan or 2,000 yuan a year, right? And then accruals which are yet to be received or paid. So let's just talk about that. Deferral is adjustment for payments of an item or receipt of cash in advance. Deferrals are prepaid expenses or unearned revenue.